season. We're here again. And normally I would kick off this week with a video on the banks, but I'm not going to do that for the first time in, I don't know, 10 years. I'm going to lead off with the other companies that are reporting this week because I think it's kind of important to take a look and see what's going on in the rest of the economy. The banks will be important to lead us off, but these other companies are going to give us further insight into what's going on with the consumer and whether or not we're really going into a recession or what's happening out there. So I put together 5 key names that you should watch this week. They're all reporting on the same day on Wednesday. So let's dive in and take a look. So the first company is Delta Airlines, the first of the airlines to report every quarter. And as you can see, they've actually missed 3 out of the last 4 quarters. But a couple weeks ago, they came out and said that they're still seeing the real strong bookings and that they don't see that ending anytime soon. So you can see that the stock took off and the surge, getting close to maybe a 3-year high here. It is up 46% now year to date off of this recent surge, but the shares are still cheap with a PE of just 7.7. And remember, the airlines are not paying dividends yet, or at least Delta is not, but I don't think many of them are. So, what to make of Delta? Can they give us even more of a surprise on the actual earnings report? I don't know because they've already basically pre-announced how good things are. But all the transports, including the airlines, are definitely one to watch this quarter. So we'll see what happens this time. Then we're going to switch it over to another hot area, PepsiCo, ticker PEP. And you can see what a great chart. It hasn't missed at all in 5 years. And remember, this includes the pandemic period. That's impressive. So they've been able to manage the expectations really well with the analysts, and that's important. And the shares have continued to just kind of grind higher. It's up and down, but still ending up higher. And even this year, hitting new 5-year highs. Now it's only up 2.8% year to or no, it's up 27% year to date. It's paying a 2.8% dividend. Yes, PepsiCo is still paying its dividend, but this stock isn't cheap, and neither are the other consumer product brands that are similar to Pepsi with the beverages and the snacks. It's trading at 25 times, but the market so far hasn't rejected these stocks trading at these higher levels. But will that be happening sometime soon? We don't know, but this is definitely one to watch. Also on the food side, ConAgra, ticker CAG, it kind of has been holding in this trading range throughout the pandemic after it got that boost off of the 2020 lows. It has a good earnings surprise track record the last couple of quarters, putting together 5 beats in a row. But the street doesn't really care. It has been selling off these food type companies this year, especially as inflation has started to come down. That's impacting, their margins, and commodities struggling a bit here. So we see these shares down now almost 14% year to date. It is cheap, trading at 11 times forward earnings, and it pays a big dividend. They have paid the big dividend to kind of keep you in the stock. That dividend is yielding 4% right now. So ConAgra on the food side, this is going to be one to watch, whether or not the street is just overreacting or if we really will see the slowdown here in the earnings. Then we're going to go to another hot stock. Who knew all these other stocks outside the banks could be so hot this week? And it's Cintas, ticker CTAS. Now, they used to report a week or two ago, historically, and they used to report on the same day as Micron. And I think they just got tired of being in Micron's shadow because look at this chart. No misses in 5 years and the shares grinding higher at new 5-year highs here in 2023. So why should they have to be in Micron shadow? They shouldn't. So now they've pushed it forward a bit and they're reporting outside of the Micron period, but they're basically up against the banks now for any kind of PR or, to have some sunshine on what they're reporting. And I don't think it's going to be a close call. I do think Cintas is going to be in people's views this week. Now, Cintas, remember, is the uniform company. So that's what makes this chart even more amazing is that the growth they've had in the uniform side of the economy. And this is definitely one to watch because you'd think in a recession, people are going to hire less, there's going to be less need for the uniforms. But so far, we're not really seeing that. Over the last 5 years now, these shares are up 145% versus just 73% for the S&P 500. It does pay a dividend, but it's only yielding 1% now because it's been on this hot streak the last couple of years. And the shares are really expensive, more expensive than Apple here at 34 times. And also, while it does have the growth, it is on the slower side of the growth component. But it's been trading this expensively for several years. I've been complaining about it, and that hasn't stopped it from going up to new 5-year highs. So Cintas, also one to watch on both the hotness side and this momentum, as well as what's going on in the actual economy. And then we're going to wrap it up with another company that should show us what's going on in that actual economy. Fastenal, I've talked about this one many times in this opening week. You can see its great earnings surprise track record. Its last miss was right before the pandemic, actually, and then it's managed to beat since then. Shares are surging and did hit that 5-year high there in 2022. Remember, they're manufacturing and construction building side. And the building side has been strong, both on residential, on the home builders, as well as on the commercial side. Yes, the big city downtowns may be struggling, but hotels, casinos, airports, these other things are not. And we have the big infrastructure bill that's in play now, too. But they always track kind of with the manufacturing side. But they haven't been because manufacturing has been in a recession the last couple of quarters. But what's going on with these shares? They have rallied this year and are up 24.4% versus the S&P up just 14.8. So that's nice outperformance. But shares are not cheap. I've been waiting for them to get cheap. I would love to own Fastenal. I've talked about them for years, but it's still trading at 29 times. And that's a little bit too expensive for me with its growth projections. But you do get paid a dividend yielding 2.4%. That's not too bad on the dividend side, but it's just a little too hot to trot here. And if it would only pull back further, it didn't even pull back enough for me in 2022. But we'll see what they say. This is definitely one to tune in to get some ideas of a slowing economy or a possible recession coming. But so far, they're not really seeing it. So that's Fastenal, ticker FAST. So you can see there's a lot going on outside of the banks. I will be watching the banks as well, especially the regionals. And usually the first out the gate on the regionals is PNC Financial, which is reporting next week, actually, along with Bank of America. But we're getting a bunch of the other big guys this week, including JP Morgan, Wells Fargo, and Citigroup. So I'm going to be tuning into all those. Make sure you follow my Twitter account. Yes, I'm still on Twitter, or StockTwits, because I'm going to be tweeting out a lot of the bank charts this week and next week. You don't want to miss those and all the other interesting charts and what's going on out there. So follow me at Tracy Reineck on Twitter, and you'll get even more content. But I'm here for the duration of the earnings season. So you don't want to miss a single one of these episodes. Get them on Zacks.com/YouTube and also on Zacks.com. You can get them on either one, but get them somewhere. And I'll see you again next week with some more earnings charts.